real estate news in our Property Player series. We regularly talk to real estate players asking where the smart money is flowing. Well, investor and developer Jacob Frydman, chairman and CEO of billion-dollar REIT United Realty Partners, along with Zogby Analytics, has put together a real estate confidence index, judging how his peers size up the landscape, particularly as those interest rates are poised to rise. He joins me now this morning to share results. Great to have you here. Thank you for being here.
Thank you, Alex.
I just want to get your take. You know, $147 million home that just beat the record just 2 weeks ago, which is $120 million set in Greenwich, Connecticut. What do you make of these numbers?
Big numbers.
Big numbers.
Real estate's attractive and getting more attractive, and I think that's what we're learning from our confidence index as well.
Yeah, so tell me one of the highlights. Where are investors putting their money in real estate?
Well, investors today are looking at where they're going to shift their money in real estate. So you're seeing investors looking to expand their portfolio holdings in multifamily and industrial. And what I thought was very interesting from the first United Realty Zogby survey is that investors are looking to get out of triple net leases.
What is that, for those of us not in the know?
So triple net leases are typically long-term investment grade leases where you have a single credit tenant leasing a property and taking on all the responsibility. So the owner basically gets a check. It's a coupon. It's been a great, safe investment for the last several years, and it's been impacted positively by the rise in cap rate compression. But as we're seeing, interest rates are rising, and with that, capitalization rates will be rising. And as capitalization rates rise, those types of assets start to look a lot more like bonds. And so bonds typically fall when interest rates rise. So people are recognizing that it may be time to divest of those types of holdings and start to look at more actively managed real estate or real estate with more inflation-protected leases.
Which comes with, I'm guessing, more risk also.
Well, you know, risk is a relative term, right? So there are people who, you know,
but if you have one trading like a bond, and this is not trading like a bond, my assumption is it's going to be a little bit more risky, maybe more volatile.
Well, the credit might not be the same, but it's more actively managed. But of course, you have greater upside, right? But risk is relative.
Risk is relative, but it sounds like there could be some more volatility in there. Also, you're seeing these big numbers like that $147 million property. I mean, do you get worried at all? Are investors concerned about what the top might be? Is there any bubble talk right now?
So not really. And what we've learned, so we've started this United Realty Zogby Index, which is going to come out quarterly, and the first one is being announced today in the first quarter of 2014. And what we're seeing based on that index is that 96% of respondents, elite real estate investors, believe that the market is attractive and getting more attractive. And so we're seeing that there is a demand for more real estate, and expectation that the demand, in fact, is going to be higher than the supply. And
you mentioned in terms of where the demand is, there was multifamilies, but also in industrials. You know, when I think commercial real estate, I think malls. Tell me where the real money is in commercial real estate.
Well, the real money in commercial real estate over the next several months or years will be in inflation-protected leases, i.e., properties that have leases where you can increase rents, either like apartment buildings, short-term duration, or hotels, or industrial assets where you can build in a CPI increase into your rents.
Interesting. And are there any areas of the country where it's doing better and seeing more demand from investors than others?
Well, we have not segregated our index on geography. We did it as a nationwide index. But, you know, we're sitting in New York City, right? And Manhattan is the Cinderella city. And we're seeing right outside of Manhattan $147 million houses.
Oh, true.
So,
but what about you personally? What are you personally doing right now?
So we have been investing in multifamily. We're actually building a new multifamily building. The first time we've done that in a while. We are not buying retail at all. We believe that retail is overbuilt in America. You know, there's 43 square feet of retail space for every U.S. citizen, compared to 23 in Canada and 13 in the United Kingdom. And as you know, many people are now shopping on the internet. So bricks and mortar retail is something that we've been divesting of. We like data-related centers. We like medical because of the demographic shifts and population changes. And we like industrial because distribution is going to become more important as people shop more on the net and less in stores.
And is there anything you're noticing geographically in your investments?
Well, the major cities and the Cinderella cities like New York, Boston, Washington, San Francisco, very, very strong and getting stronger. and we're seeing strong cap rates.
Will my apartment appreciate in price over the next 5 years? Park Slope, Brooklyn? Tell me yes.
Am I taking out my crystal ball?
Yes.
Likely. Very likely.
I will take that. My husband will be so happy. All right, thanks so much. Good to have you, Jacob Frydman, Chairman and CEO of United Realty.